we could look at reducing the policy rate in future years, 2020, maybe late 2023 or 2024.
When there's optimism, when there's greed, when there's risk tolerance and so forth, that's a very difficult climate for the value investor.
It's a hurricane. That hurricane is right out there down the road coming our way.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine Lacqua. Here's what's coming up on today's program. Hurricane warning. JP Morgan CEO Jamie Dimon warns investors of an unprecedented combination of challenges to the U.S. economy. Off the boil, oil prices drop after reports Saudi Arabia may boost production. OPEC Plus meets today. Plus, metamorphosis. Sheryl Sandberg steps down from Meta after 14 years, having helped transform the social media startup into a multi-billion-dollar powerhouse. Happy Thursday. It is a more than quiet Thursday, given that the UK is off on holiday. You have an HK holiday tomorrow and China. So volumes are light. Here's how the picture is shaping up cross-market. Euro Stock 600 up about 1/3%. Again, UK offline. So volumes I've seen off as much as 15%. So probably any of the bulk of market moves would have been put on yesterday. Your 10-year yield, that continues to move higher, not even by a basis point, but still, it has been a global move of rates higher after yesterday's Bank of Canada decision. Back-to-back 50 basis point hikes, saying that they are able to do more. They will do what it takes to reach their 2% target. And of course, some hawkish noise coming out of the ECB as well. So that is a really global story. Also looking at S&P 500 higher by 0.2%. Now, Brent crude, that was also falling by 2% after these reports that Saudi may step in to make up for the lost amount of oil coming from Russia. Now, from the map, again, a lot of mix here. You see the UK in the red. Just ignore that. That's yesterday's price action. Again, it is closed today and tomorrow. DAX were higher by about 0.5%. CAC 40 were also higher by 0.6%. So perhaps just giving back a little bit of yesterday. Not unusual to see that back and forth. But again, because volumes are late, there is that opportunity for volatility. You especially might see that as we get closer to the U.S. Open when volumes finally do pick up. Now, JP Morgan CEO Jamie Dimon has warned that the U.S. is about to face an economic hurricane. He was speaking at the annual Strategic Decisions Conference in New York City and drew attention to struggles against fiscally induced growth, quantitative tightening, and Russia's invasion of Ukraine.
It's a hurricane. Right now, it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself.
But for some at Dimon's firm, the calm before the storm may also provide an opportunity, or it's already priced in. Strategist Marko Kolanovic wrote in a note to clients yesterday, "We remain positive on risky assets due to record low positioning, bearish sentiment, and our view that there will be no recession given supports from U.S. consumers, global post-COVID reopening, and China stimulus recovery." Of course, he's been bullish for most of this year. Now, we've also spoke to Oaktree founder Howard Marks. He told us that he sees a better investment environment for bargain hunters.
Attitudes are more balanced today, but when there's euphoria, when there's optimism, when there's greed, when there's risk tolerance and so forth, that's a very difficult climate for the value investor to find bargains. Now the prospective returns on many asset classes are higher than they were just a little while ago, and again, a much better climate for the bargain hunter.
Let's get straight to the markets conversation now with Mark Hafele, UBS CIO for Global Wealth Management. Mark, it is a very difficult environment for many folks watching this program who are participating in this market. Is this the kind of market that you want to be on the sidelines, or are you like Howard Marks bargain hunting right now?
Well, we are bargain hunting in the sense that we have the same focus on value. And I think, if you put together that great litany of comments, there's a lot of disagreement on many things that are out there. But one thing that's clear to us is that we are going to end this year with inflation above the Fed's target. And what we've found is that when inflation is above 3%, and we expect to end the year above 3%, value stocks outperform growth stocks. And so that's key to how we're thinking about this market right now.
We've heard folks say that, look, growth has sold off to the point where a lot of them are starting to change into value stocks. Mark, is it really that simple that some of these growth names have sold off enough that they are now in your value bucket?
Well, nothing is simple right now, but I would, yeah. I think that where you have quality growth or quality value, where you're starting, and maybe some of these growth stocks are former growth stocks are starting to fall into this category, where you do have strong buyback, strong shareholder value. You can fit them in that bucket. But I think for us, when we screen these things, I think we're leaning more towards stocks, say in the UK market, which are more focused on commodities and energy. It's still more traditional value than a portfolio of former growth stocks.
When we're talking about some of these factors, Mark, value versus growth, that's a traditional one, but one that has historically worked very well is momentum. Now, Kyu-Sung Lee of Carlyle was speaking yesterday saying that the momentum trade is gone. We're back to fundamentals. Do you see something similar, the value trade, the momentum trade rather evaporating in this environment?
Well, it's hard. It depends, I guess, on what your momentum signals are focused on, but it's certainly been a very choppy market, and that's harder for so that can be harder for CTA focused funds or even global macro funds. So we're pleased that kind of the value more on the stock picking approach is working for right now, but that can change as we start to set up what could be something more of a significant shift, because we saw that rise in interest rates, and we saw that tremendous interest rate volatility, which contributed to the fall in stocks. But if that rate vol comes out and people start feeling like the Federal Reserve's hikes have been fully priced in, then we could indeed settle down. And we think that, based on what people have already priced in, we can end the year with the S&P 500 higher from these levels.
Is that your base case?
In our base case, we're looking at something like 4,300 for the S&P at the end of the year. Yeah, I think people have to realize a little bit that there's some kind of a cap on how far equities can maybe go up this year, because if they start doing too well, that's a free fire zone for the Federal Reserve to start talking markets down again.
That is something that Mike Wilson over at Morgan Stanley says. So do you agree with this idea that stocks rallying, that's just going to push the Fed to go harder, faster?
Well, I don't want to say, I can't speak in detail of all of Mike's forecasts, but what I would say is that the more markets go up, the easier it is for the hawks on the Fed to become a little louder. But again, we don't think the market has kind of reached where fair value given the circumstances we see today.
All right, Mark, you're going to stick around with us. Much more to discuss. Mark Hafele, UBS CIO for Global Wealth Management. Coming up, crude slides on a report that Saudi Arabia could replace lost Russian oil. We're going to bring you the latest on the world's most important commodity next. This is Bloomberg. economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, with the UK on holiday, volumes are light, off as much as 50% for some of these European markets, but still looking at gains in the Europe Stock 600, about a third of 1%. We'll see if that picks up at all as volume picks up when we get closer to the U.S. Open. Continuing to see U.S. 10-year yields moving higher, bonds selling off ever so slightly, but pushing closer to that 3% yet again, given that global central banks, be it the Bank of Canada, be it continuously from the Fed, and of course the ECB, more hawkish noise coming out of there. Oil, one to keep our eye on. We're going to discuss that in just a bit, but Brent crude moving lower by 2.2%, given that there are noises, or at least speculation, that Saudi might do more to offset the loss of production crude. Let's get to our other top stories around the world with the Bloomberg First Word News is Angel Feliciano. Hi, Angel.
Hi, Danny. Bloomberg's been told that the EU efforts to approve a partial ban on Russian oil imports have hit an obstacle, with Hungary raising new or already rejected demands. That's further delayed a push to clinch a deal. Our sources say EU ambassadors may meet again on Thursday in Luxembourg to try to greenlight the bloc's 6 sanctions package against Moscow. The Eurozone is moving closer to adding its 20th member. Croatia has been ruled to be suitable to join the club next year. The European Commission recommended that the country should be allowed to adopt the common currency after finding that it fulfills the necessary requirements on issues including inflation and public debt. Banks in China are facing growing pressure to support cash-strapped property developers. Regulators have been pleading for months, but that hasn't boosted lending to the industry. Builders and regulators are counting on banks to provide a lifeline as bond funding and home sales dry up. Russia has been judged to have breached the terms on a bond after missing a $1.9 million interest payment. That failure triggered an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said the event occurred on credit default swaps because Russia didn't include the additional interest in a late bond payment made at the start of last month. Bank of England Deputy Governor John Cunliffe says the UK housing market is starting to slow. Speaking on ITV News, Cunliffe said property prices will be dragged down by rising interest rates and easing economic growth. The remarks followed a 10th consecutive monthly rise in house prices, even as living standards get squeezed. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny.
Angel, thanks so much. Angel Feliciano there. Let's get the latest on oil markets ahead of today's monthly OPEC Plus meeting. We're watching crude prices dropping. That follows an FT report that Saudi Arabia is ready to pump more should Russian output decline due to increased sanctions. Now, the group, which again meets today, is expected to ratify a modest increase in output for July. Joining us now is our energy reporter in Singapore, Stephen Stupczynski. Stephen, thanks for hanging around for us. So first off, does Saudi and the rest of OPEC actually have the ability to offset the loss of Russian oil?
That's the big question, and I think there are a lot of doubts about that at the moment. For a long time, Saudi Arabia and other countries have struggled to even hit the modest increases every month of 400,000 barrels a day. If suddenly you take out a chunk of Russian supply, they're one of the world's biggest exporters, that's going to be very difficult, and it can't happen overnight. But that is what Saudi Arabia is telling Western allies, according to the FT. They said that they, Saudi Arabia, as well as the UAE, would be able to meet that deficit. This year, we could see Russian exports fall 8% because of oil bans in the U.S. and in Europe. That would cut a lot of the market and a lot of instability. But Saudi Arabia says that they can meet that supply. Don't worry, and that's why markets are falling today.
Stephen, thanks very much. Stephen Stupczynski there with a roundup of the latest on Saudi and oil. Mark Hafele is still with us, UBS CIO Global Wealth Management. Mark, let's put aside for a second of the likelihood of this happening and instead focus on the drop of oil prices. Should this happen, should oil prices start to drop, can you walk me through the ripple effects that would have across assets?
Well, if oil prices were to fall, I think the most important effect there is that inflation expectations might also fall, and that gives gives maybe people the idea that the Fed has more room to maneuver in the back half of the year, puts views that we're going to move into a recession further out. And, it could be very good for markets, and it's certainly good for consumers. But oil prices falling is a big if, and it's really not something that we're counting on.
Right. And then you have the other issue of it not just being an oil supply issue, right? You have China, for example. I mean, if oil were to fall, is that even enough to bring relief to the Fed?
Well, I think you make a good point, because if you look at the oil is such a interesting global picture. And if you look at what's happened with the zero COVID policy and how much growth that's taken out of China, which, China's been the largest source of growth for the global economy. Should China come back online, that is going to be increased energy demand. And so we see commodities and oil and energy stocks as an important part of portfolios here, because first, we think that on the demand side, if the macro picture or the geopolitical picture improves, that can help support oil prices. And then if we have further geopolitical tensions or issues around the war in Ukraine, that can also drive the prices higher. So it's a very important asset right now where we're overweight.
Mark, less than a minute to go, but beyond that, you say you're recommending hedges. If there's one market I'm to look at, again, let's put aside energy for a moment, where you are finding hedges, safety in this market, where are you seeing it? And again, about 30 seconds here, Mark.
Well, I think one sector in equities we would look at is healthcare. They've really been hit hard, but we expect the valuations and the continued demand for things like drugs and the dividends in pharma to be something of a hedge for equity portfolios.
Mark, a great roundup of that trade in just 30 seconds. Apologies, out of time. We're going to have to end it there. Mark Hafele, UBS Switzerland CIO Global Wealth Management. Thanks so much for joining us. Now, coming up, Sheryl Sandberg is stepping down as Chief Operating Officer of Meta after 14 years as Mark Zuckerberg's second in command. We're going to bring you that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Sheryl Sandberg is stepping down as Chief Operating Officer of Meta after 14 years as Mark Zuckerberg's second in command. Ed Ludlow has more from San Francisco.
Over 14 years, Sheryl Sandberg has taken the company formerly known as Facebook, now known as Meta Platforms, from a fledgling startup and social network to an advertising behemoth that brought in $120 billion of sales last year. Sandberg's going to stay on Meta's board, but the writing's been on the wall for some time. A lot of folks have asked the question, will Sandberg stay? There was a report in July of 2021 of a rift between Mark Zuckerberg, the company's founder and CEO. In a conversation with Bloomberg, Sandberg gave her reasons on why now is the time for her to leave the company.
The decision I didn't come to lightly, but it's been 14 years. It's been 14 years, and I want to make more room to do more philanthropically, to do more with my foundation. I've definitely not been able to do nearly as much as I have wanted to recently. It's a really important moment for women.
When Sandberg joined Facebook in 2008, it was just a fraction of its global user base that it has now. Mark Zuckerberg was a college dropout with very little experience, and Sandberg's played a very central role on Meta and Facebook, growing to a multi-platform company that has more than 1 billion users in more than one of its platforms. But her replacement is also capable. Javier Olivan has been focused on the company's growth initiatives for some time now. He's a former VP of product working on all of the platforms, not just the core Facebook product. But it was interesting to see the stock fall so sharply when the headlines of Sandberg's departure crossed the Bloomberg, investors identifying perhaps some key man or key woman risk in that announcement. And Facebook's also in a transition, or Meta is also in a transition from being an ad-based model where it relies on users being targeted with ads on its platform to a future in the metaverse where it wants to sell more hardware and have users spending on services that are linked to experiences in the metaverse, experienced through virtual and augmented reality. Ed Ludlow for Bloomberg News in San Francisco.
And of course, Facebook shares falling about 2.6% after that. Now, when it comes to this market, we did have Swiss inflation coming in at a 2008 high just about an hour ago. From that, we've seen some strengthening in the Swiss franc, be it versus the dollar, slightly versus the euro. And this also comes off the back of euro inflation coming in over 8%, a record there. More talk about ECB coming in hawkish. We, of course, had Villeroy saying that inflation, it's too strong, it is too broad. Holtzman also talking about 50 basis points. Deutsche Bank breaking consensus, also predicting a 50 basis point hike come July or September. Now, coming up, preparations underway for the Queen's Jubilee weekend. So markets are closed here in the UK, but we'll talk about which markets are opened and any volatility we could see with the late volume. That's next. This is Bloomberg. Hurricane warning. JP Morgan CEO Jamie Dimon warns investors of an unprecedented combination of challenges to the U.S. economy. Off the boil, oil prices drop after Saudi Arabia report that they might boost production. OPEC Plus meets today. Plus, metamorphosis. Sheryl Sandberg steps down from Meta after 14 years, having helped transform the social media startup into a multi-billion-dollar powerhouse. Good morning. Happy Thursday to you. It's Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Now, a lot of cross currents, a lot of crosstalk in this market. Among them, JP Morgan CEO Jamie Dimon warning that the U.S. is about to face an economic hurricane. Speaking at the annual Strategic Decisions Conference in New York, Dimon drew attention to struggles against fiscally induced growth, quantitative tightening, and Russia's invasion of Ukraine.
It's a hurricane. Right now, it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself.
But for some, the calm before the storm may also provide an opportunity, along with Klonovich seeing a opportunity for stocks to end the year flat. Oaktree founder Howard Marks told us that he sees a better investment environment for bargain hunters.
Attitudes are more balanced today, when there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. Now the prospective returns on many asset classes are higher than they were just a little while ago, and again, a much better climate for the bargain hunter.
Well, joining us is someone now who is very accustomed to value investing and has taken advantage of it. It's Alexandra Morris, investment director at Norwegian fund management firm Skagen. Alexandra, thanks so much for joining us. And I know your strategies have benefited from the rally in value stocks. But as we hear more sentiment that perhaps we're now in an environment where a Fed hawkishness is fully priced in, does value have further to run?
Well, I do believe value has a long way to run, because you have to remember where it came from.
Yeah, well, expand more on that, Alexandra. Where did it come from?
Well, it came from extremely lows. We've had, what have we had? About 12 years of consecutive value stocks underperforming growth stocks. With the discrepancy is an all-time high, and therefore we've just barely started on the run for value stocks.
Where do we stand in terms of sentiment? Because you're right, Alexandra, for so long it had been value doesn't work. Decade after decade, it's gotten beat down. Do you see a change in environment where growth investors, you know, the Tiger Cubs of the world, are going to come more on side with that thinking?
Well, yes, I do. I think we've seen a huge shift over the past, say, 6 months with particularly high valued growth stocks, or especially those who are not earning any money, coming crashing down. And value stocks have done very well.
You point to the stocks, the growth stocks that aren't earning any money. As we look at tech being hurt pretty momentously, does there need to be a change in business models for a lot of these companies to succeed at the moment, where it's no longer growth at any cost, it is producing cash flow for investors?
Yeah, cash is king, and it's always been king. So we've had an era now where we've had a violent rush to the most popular stocks, and of course, the more you buy, the more the price is inflated. And you know, they may be fantastic business models, but you do have to have a mind shift that at some point investors will demand cash flow, hard money.
To that point, Alexandra, Kyu-Sung Lee of Carlyle, the CEO over there, says, look, the momentum trade is dead. It's about investing in fundamentals. Alexandra, is that right? Is the momentum trade dead?
No, I wouldn't put it that harshly, but I would just say that go back to your spreadsheets for cash flow and don't jump on the bandwagon of popular stocks. You know, it has to hurt when you invest. That's when you can find the real bargains.
While we're talking about our spreadsheets, Alexandra, tell me what it would mean if Saudi indeed does put more oil into the market. Let's say we see oil prices and Brent crude drop below $100. What does that input do to your models, to your equity allocations?
I don't think a drop down to $100 would have much impact on the equity models. We've $100.
What would then, Alexandra? What would make a difference? What would make a difference to your allocation? What level would you actually see a difference to what you're allocating to?
Well, now you're asking a difficult question. When you're long-term investors, you don't allocate from this kind of sector to another sector overnight. But I would say that we are in an era now where energy is scarce. And so if for some reason there should be a huge recession, demand dries up, and Saudi turns up on the taps for oil, then we could see the oil price dip severely. Would that matter? I don't think so, because we are in a long trend for energy. So it would come back up again, basically.
All right. Alexandra, thanks so much for joining us. Alexandra Morris there, investment director at Skagen. Coming up, cocktail-savvy consumers help Remy Cointreau post a strong year. We're going to discuss their earnings next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Remy Cointreau's earnings rose 40% in the year through March on an adjusted basis. And the outlook, it's positive for the cognac maker. It sees strong sales growth this year despite concerns over China's ongoing lockdowns. I spoke with Remy Cointreau's CEO Eric Valla earlier today.
On the short term, there will be an impact when the country is locked down. It's a very severe lockdown, and you see the restaurants and the clubs closing, which does impact our business. If you look at medium and long term, the demographic prospects are very interesting in China, very interesting, particularly for products like ours. And we see beyond cognac a growing interest on top of that on whiskies, which I think is a very good news for a group like ours.
Let's bring in our Bloomberg senior consumer staples analyst, Duncan Fox. Duncan, I mean, look, we've had other alcohol companies, Pernod Ricard comes to mind, that have warned about lockdowns in China impacting demand. What do you think makes Remy more confident? We're hearing from Eric there saying, okay, at some point they're going to open and there's going to be more demand. Are they in a different position, or is it just different expectations about what happens to the Chinese economy?
I think there's a little bit of different expectations there. There's no doubt that Remy have done a lot of job on their inventory in the trade, and I think they've got it down pretty much as low as they can. So as you start to see reordering when the towns, cities, etc. reopen, you'll probably see a nice little bounce back for Remy in terms of sales. So I think it's just the way they've run the business. They're very, very close to their inventory in each market. So they've done a very, very good job on that.
I have to say the other interesting thing I thought in speaking to Mr. Vala was this idea of they can continue to raise prices. They did back in April. He said that they're not planning on it, but it's something that they could do and that they would be looking at doing. But Duncan, we are in a world where cost of living crises are starting to emerge in the UK and other places. Is there any evidence of price elasticity on consumer goods yet, that's starting to finally hit prices?
It's interesting. I would probably say the Remy business is very much more premium and luxury. So there's certainly no pressure, I think, on luxury pricing at the moment. But certainly in the wider consumer staples area anyway, you may be starting to see a little bit of a shift. So far, we're seeing roughly about 5% pricing for most consumer staple stocks, even up to 10% for some. And there's been a little bit of a volume decline, or slowdown really, rather than decline. But where it's difficult to know is whether that's because, last year food service and pubs and clubs reopened, so there was a massive bounce, versus actually genuinely we, the consumer, starting to cut back. I think on lower priced products or more daily products, you're definitely going to see some pressure as we go through the next couple of quarters because, as Eric Vallant said there, further pricing is going to be required, possibly up to about 10% for some of the food companies, given the way costs of goods have gone up in the last sort of 3-4 months. So it's pretty difficult times for these companies.
Given the difficulty doesn't seem to be easing, given that supply chain disruptions have maybe eased but stuck around, have we seen any shift from the just-in-time model to more companies having buffer stocks?
Definitely. I mean, just out of interest, Nestle have added something like 2.6 billion Swiss francs of inventory over the last 2 years. Now, part of that will be deals that they've done, but there's no doubt they have made sure that they've got just-in-case inventory, I suppose, rather than just-in-time. For really key ingredients. So the one that really stands out at the moment, though, is sunflower oil, where obviously Ukraine and Russia was over 60% of production in 2021. So that's a product that is key in nearly all food processing businesses. So if you suddenly can't get it, you need to find something to replace. That's particularly sunflower oil's got no taste, so you've then really got limited options. So you probably do have to go out there and make sure that you've got stock so that you can take yourself through the harvest. And certainly for a lot of the food companies I cover, I think that is the issue that they've got to wrangle with over the next sort of 6 months or so as we go through the harvest periods.
Duncan, thanks so much. That's Bloomberg's Duncan Fox. Now let's get to your Bloomberg Business Flash. With that is Angel Feliciano. Good morning, Angel.
Danny, Pfizer has asked U.S. regulators to approve its COVID vaccine use for emergency in children under age 5. Last month, Pfizer and its partner BioNTech announced in late May that 3 shots were highly effective in kids. Their trial is likely to pave the way for infants and toddlers to get immunized. Lawyers for Goldman Sachs have asked a New York federal judge to suppress the names of 2 senior executives in one of Wall Street's biggest gender discrimination lawsuits. Women suing the bank have asked for disclosure of filings naming, quote, high-ranking alleged sexual harassers. Goldman says the executives are not defendants in the class action, and such disclosure would sensationalize the case. Several Chinese traders are complaining that they were duped into providing loans against artificially inflated aluminum stockpiles. A similar, though much larger, scandal rocked the market less than a decade ago. People with knowledge of the matter said that at least 3 companies lent a total of more than 500 million yuan against stockpiles of the metal stored in a warehouse in the southern province of Guangdong that turned out to be worth significantly less than that. Elon Musk has given an ultimatum to Tesla employees, saying everybody at the company has to return to the office. The Tesla CEO sent an email to executive staff with the subject line, "Remote work is no longer acceptable." He wrote that anyone who wishes to do remote work must be in the office for a minimum of 40 hours per week or leave Tesla. And that's your Bloomberg Business Flash. Danny.
Angel, thanks so much. Angel Feliciano there. European Trade Commissioner Valdis Dombrovskis has told Bloomberg that nothing is off the table when it comes to hitting Russia's economy. That includes possible future sanctions on Russian gas. In an exclusive interview with Maria Tadeo, he said the latest EU sanctions package strikes at the heart of Putin's war machine.
We need to continue to support Ukraine, including by military support, which is probably the critical one now in a short term, and we need to continue to put pressure against Russia to stop its aggression. And from that point of view, the fact that finally there is agreement on a 6 sanctions package, it's an important fact. And indeed, there are major steps like oil embargo, not fully as European Commission was proposing, but anyway, at the end of the year it will be 90% less imports of Russian oil. Also the fact that we are de-swifting the largest Russian bank, Sberbank, so it's a very substantial package. So we need to continue to do this pressure, so to support Ukraine and to continue pressure against Russia.
And if when you implement this package, and if you believe that it will be fully implemented, do you have any internal calculation in terms of the economic damage that this is going to do to Russia? A lot of this is about preventing them from funding the war, to be in a position where they don't have the financial means to continue to push on the battlefield. Do you have any estimates in terms of the actual impact that it could have?
Indeed, if you look at the situation pre-war, 62% of Russia's exports to the EU were fossil fuels. We have already banned coal import in one of the previous sanction packages. Now we are pretty much banning oil imports, so we're really getting to the heart of the financing of Putin's war machine. And also the other measures related to Sberbank, to other Russian banks and other steps we are taking, they are going to have substantial impact on Russia's economy.
And of course, you mentioned coal, then it was oil, and the way that the European Union kind of hinted and calibrated this is that the final step would be gas. Are we going to see sanctions on gas, which is seen as the big geopolitical weapon of the Russian Federation?
As we had been saying from European Commission very consistently, all options are on table. So we are not excluding anything, but it also must be said that regardless of sanctions, the strategic decision to move away from dependency on Russian fossil fuels is already taken, and there is already a plan in place, Repower EU plan, to describe how we'll be doing this, including rapid phase-out also of our dependency of Russian gas supplies.
Your message to Russia is that ultimately this is going to end one way or another. It's the end of Russia as a great energy power, I believe, essentially. This war will trigger that for them. They were a big player in the energy market. With the measures taken by the European Union and as the powers that you also point over the long term, this will be the end of it for Russia.
It is going to be the end of energy relations in this form between Russia and EU. Obviously, the EU is not the only buyer in the world market, so Russia will be seeking alternative markets for its energy, but right now we are seeing that they are actually selling, for example, their oil at some 30-35% discount.
And of course, the market is also paying attention to that and predicting more discounts will happen after the measures that were announced yesterday. So ultimately, it's not a good deal for Russia, even if they turn to India or China. Is that what you basically operate with? Even if they try to buy new or find new buyers, this is not a good financial deal. You're going to lose money either way.
Exactly. And of course, Russia is making lots of emphasis to increasing supplies to China. But what we are seeing, and especially in this situation of Russia's weaknesses vis-a-vis China, China is going to take a good advantage of this, and it's not going to be very advantageous deals for Russia.
European Trade Commissioner Valdis Dombrovskis speaking exclusively with Bloomberg's Maria Tadeo. Coming up, as millions across the UK and Commonwealth prepare to mark 70 years since Queen Elizabeth II ascended to the throne, we're going to take a look at some of the possible economic pitfalls and positives of the Platinum Jubilee. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. It's the Queen's Jubilee bank holiday in the UK today, and many people who don't work in television, can you tell someone in TV wrote this, will be looking forward to a few days relaxing at home. But what effects might we see on the country's economy? Laura Wright, who is also suffering with us here, not on holiday, has been investigating. Laura, of course not suffering. You've had the joy of looking through the economic consequences. So tell us, is there any short-term bounce we can expect from the Queen's Jubilee?
Yes, Danny. Well, forward-looking data says a revenge spending bounce is likely across retail, hospitality and the travel sector as we stock up on our Victoria sponge, prepare for street parties, visit friends and family. Springboard data shows us that retail footfall for this week is expected to be 8% higher compared to last week. And for the same period, high streets projected to be the biggest gainer, followed by shopping centres and retail parks as appetite for spending becomes conspicuous. Hospitality is set to bring in £2 billion over the extended holiday. That's according to a survey led by UK Hospitality. To put that in context, it's almost £400 million higher than a typical Thursday to Sunday at this time of year. Pubs can stay open until 1 a.m. It's probably still way past our bedtime, Danny Berger. But what is really interesting is the travel sector, beleaguered by the pandemic, but passengers are showing a real appetite to travel abroad. Flight data from Cirium reveals that UK flight departures from the UK are up over 200% year over year from June the 2nd until June the 5th, and up over 1,000% compared to the same period in 2020. Really, Danny, it's a go big or go home approach this weekend.
Laura, quickly here, I mean, are there any other consequences of just having these extra bank holidays?
There are, unfortunately, as much as we would like this to be an annual fixture. If we use historical examples of when an extra bank holiday was added to the month of June because of Jubilee celebrations, such as in 2002 and in 2012, typically for that month, the UK economy contracted on average 2%. The dotted line for the periods shows us how GDP would have behaved without an extended bank holiday. Using this analysis, such an event knocks quarterly GDP by 0.5%. So for the second quarter of 2022, GDP is set to be in contraction territory, and that aligns with the Bank of England's view. Danny.
Laura, thank you so much. Bloomberg's Laura Wright breaking down all of the data of everyone out there celebrating with a Victoria sponge and a gin and tonic. Well, as we round out the hour, continue to see light trading volume, yields higher, stocks higher as well, as we contemplate a central bank that continues on its path to combating inflation. Surveillance continues in the next hour. This is Bloomberg.
The way you get inflation down is you need more slack in the U.S. labor market. That's not a friendly message from the Fed, but that's what's necessary at this point.
When there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains.
For investors, we haven't, reached that critical mass, and folks are still focused on recession risks.
We are in this kind of bear market environment, yet we haven't seen the recession manifest in the macro data yet.
If the United States is not currently in recession, given these food costs, these energy costs, our falling income, we will be in a recession within the next 6 months.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 2nd. Our top stories today. The price of oil falls after a report that Saudi Arabia is ready to pump more crude as OPEC Plus meets today. Meanwhile, President Biden is likely to visit the kingdom later this month. Sheryl Sandberg's complicated legacy. The soon-to-be former COO of Facebook's parents built an advertising giant, but also developed a number of blind spots. We'll have analysis. And two very different views of the U.S. economy from J.P. Morgan. Jamie Dimon warns investors to brace for an economic hurricane, but a top strategist predicts a recovery for U.S. stocks. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, let's face it, attention here in London is elsewhere. It's on celebrating 70 years of this Elizabethan era with the Platinum Jubilee. But there's a lot still to talk about in markets. Oh, thanks. There's a lot to talk about in markets, whether it's hurricanes over the economy or oil, very much at the heart of things today.
Yeah, there definitely is a lot to talk about. And Anna, I'm sorry you have to work through the holiday, but I'm glad you're here to talk about it with us. Let's run through what happened in Asia overnight first, because it was a mostly down day for equities in the region, down about 0.75% for the MSCI Asia Pacific Index overall. Now, the big drag was Hong Kong. That Hang Seng Index was down a full percentage point as Hong Kong reverts back to some of its strictest COVID-0 measures, in that anyone who tests positive, even if it's a mild infection due to a subvariant of Omicron, they now have to go back into centralized quarantine. You cannot quarantine at home. So measures are restricting in Hong Kong specifically, but we know in mainland China, specifically in Shanghai, things are starting to loosen up a bit. And that is actually something that is benefiting commodities like iron ore. Iron ore futures were up a little more than 5% in Singapore overnight. We're back to around $140 as there is more optimism around the demand story, potentially from infrastructure spending to bolster the Chinese economy as well. And then on the demand story, we know that central banks in many parts of the world are trying to rein in demand in order to tame inflation. We saw the Bank of Canada move 50 basis points yesterday. Now traders are ramping up bets that the RBA in Australia also may move a little bit more. Now about 40 basis points of hikes priced in for that meeting next week. You see that reflected in the Australian two-year yield, which was up about 10 basis points overnight, Matt.
All right, we have yields rising here as well as investors let go of bonds, and maybe they're putting some of that money into risk assets today. You can see that the S&P futures are higher, almost 0.5% higher right now. The 10-year yield at 291.13, so getting closer and closer to 3, although not moving really that much, certainly not compared to what we see in Australia. Nymex Crude coming down after the FT reports that the Saudis could push up, while OPEC minus could push up production to make up for lost production out of Russia. So right now, Nymex Crude at 112.97, and Bitcoin is up 1% from midnight, but of course it's much lower than it was when we talked about it this time yesterday. It was, I think, 31.6 yesterday. Today it's 29.930, but you know, it's still hovering around that $30,000 level where it's been for the past few weeks. So not a lot of movement there. Nonetheless, we have a green arrow, so maybe that's risk on. Anna, what do you see in European markets?
Yeah, maybe the preceding risk off, something to do with hurricanes, and good data is bad news for risk assets. Let's have a look at European equity markets. Let's pretend London isn't here. Let's pretend the UK isn't here today. That's reflecting yesterday's move, of course. The rest of the continent really reflecting positivity, bouncing back a little from the sell-off we saw yesterday, and that was driven by some of those hurricane comments from Jamie Dimon and some of the better data out of the US, reinforcing that expectation that we could see more hikes coming through from the Federal Reserve. So today we see European stocks going higher. We see energy is a bit of a laggard. We'll get to the Brent price in a second, but construction stocks actually doing pretty well here in Europe. Saint-Gobain, the French construction business, giving a positive outlook. Here's Brent crude. It is down by 2.2% today. Just picking up on what Matt was saying, what Kaylee has referenced, those reports about whether we'll see further pumping from OPEC members, even if they exclude Russia from their calculations. We'll look ahead to that OPEC Plus meeting a little bit later. Remy Cointreau up by 3.7%. Apparently, this is a spirits maker in France. And apparently all the cocktails we learned to make in lockdown, we're still making them, and that's doing well for Remy Cointreau right now. We see the Swiss franc actually jumping. This is the dollar down against the Swiss franc, which has actually seen a bit of a boost today. Some inflation data, the highest since 2008, reminding us once again, just like we got a reminder from the Bank of Canada yesterday about that inflation fighting narrative that is still very much with us in these markets. I put in the pound here because it is the Platinum Jubilee, up by 0.4%. Has nothing to do with that, of course. The pound was weaker yesterday on that risk-off move into the dollar. Today we see some of that reverse, Kaylee.
All right, Anna, well, that Platinum Jubilee, obviously one of the big events that is happening in the day ahead. The UK kicking off what is actually a 4-day bank holiday weekend to celebrate Queen Elizabeth II's Platinum Jubilee, 70 years on the throne for the 96-year-old monarch. Also happening today, OPEC Plus will be meeting via video conference at 8:30 a.m. New York time. A very interesting meeting in light of the reports we got overnight on Saudi Arabia. Then Cleveland Fed President Loretta Mester will be discussing the economic outlook at a virtual event at 1 p.m. New York time. And finally, we'll also be getting some U.S. economic data, including initial jobless claims and factory orders, Matt.
All right, so a lot of data coming out that we still need to pay attention to this week. Crude prices front and center following a report from the Financial Times that Saudi Arabia is ready to pump more should Russian output decline due to increasing sanctions. Paul Wallace, who leads our Middle East energy and commodities coverage, joins us now from Dubai. So, Paul, what do we know about, OPEC's decision, especially with Russia maybe not participating as much in the meeting?
Hi, Matt. Well, a few days ago, it was looking as if this OPEC Plus meeting today would be pretty boring, and it would be just a rubber stamp exercise for the group to carry on with its previous monthly plans of gradual output increases. But something has shifted in the last few days. Essentially what it looks like is that the strained relationship between Saudi Arabia, the world's biggest oil exporter, and the US is improving, or or there's been progress made toward getting a rapprochement of sorts between the two countries. The FT is reporting that the Saudi Arabians have told some of their Western allies that they are at least willing to help fill any void from Russia if its crude exports dip significantly. And Bloomberg is also reporting that President Joe Biden's mooted trip to Saudi Arabia is likely to happen this month. So everything suggests that, as I said, there has been a change, and if things between the Saudis and the Americans are on a better footing, that could pave the way for more oil from Saudi Arabia and perhaps some other OPEC members like the UAE.
Okay, Paul, thanks very much. We will look for developments there. Paul Wallace reporting from Dubai. As Paul just mentioned there, President Biden is likely to visit Saudi Arabia later this month as record high gasoline prices weigh on the Democratic Party's political prospects ahead of midterms. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. We were just hearing about that rapprochement of sorts between Saudi Arabia and the U.S. Give us the Washington perspective.
Yeah, well, first, it's news just that he's expected to visit because, one, it would stand to reason if President Biden is visiting Saudi Arabia that he would likely visit with Crown Prince Mohammed bin Salman. That's not something the White House has confirmed, but that is, I think, a fair expectation, which would run counter to what the president had said in the past, that he would only deal with King Salman bin Abdulaziz. Any kind of further communication or easing of the tensions between President Biden and the Crown Prince would be a positive thing for relations between the two countries, or at least from the Crown Prince's perspective. Obviously, the tension is still there over the killing of Jamal Khashoggi, but it does seem to imply a sense of urgency around gas prices and communications with oil-producing countries on the part of President Biden, and maybe a bit of pressure on him on that topic.
Okay, Jack, well, let's turn our focus inward and focus on a domestic issue. I woke up this morning to news of another mass shooting. 4 people killed in a mass shooting in Tulsa, Oklahoma, just 8 days after 21 people, 19 of them were children, were killed in Uvalde, Texas. 18 days after 10 people were killed in a mass shooting in Buffalo, New York. We find ourselves here again, Jack. So I ask the question again, what is the likelihood that Congress is going to do anything about it?
The likelihood is stronger than you might think, given the long-standing inaction and the sort of sense of nothingness legislatively following, Sandy Hook, which was 10 years ago. There are bipartisan meetings. It's been virtual meetings with the Senate out this last week, but conversations led by Chris Murphy from Connecticut and John Cornyn from Texas on the Republican side about what they could do that would be very limited to try to have some sort of bill that responds to the Uvalde shooting. Now, obviously, this keeps the pressure on them. I would point out one of the topics they're discussing that seems to be some low-hanging fruit would be incentivizing state-level red flag laws, where if there's some reason a judge would feel the need to take away someone's guns, that would allow them to do that. Oklahoma is the one state in the country that has an anti-red flag law that would prohibit a state law or county or city level red flag laws. So if there is a push in Congress to incentivize those state laws, Oklahoma, which is in the news because of this shooting, would potentially be one of the main holdouts against that.
Right, but anything they will do is going to be limited and low-hanging fruit rather than, meaningful and comprehensive legislation to address the killing of children, which is, that says something about, I think, the state of the country right now. Jack Fitzpatrick of Bloomberg Government in Washington. Sheryl Sandberg is stepping down as Meta's chief operating officer. She became one of the most recognized figures in global business after helping Facebook transform from a startup into a multi-billion-dollar advertising powerhouse. She spoke exclusively to us yesterday.
The decision I didn't come to lightly, but it's been 14 years. It's been 14 years, and I want to make more room to do more philanthropically, to do more with my foundation. I've definitely not been able to do nearly as much as I have wanted to recently. It's a really important moment for women. Emily, I know you and I have spent a lot of time talking about that over the years, but it really feels like a very, very important moment when I think more focus there would really be important to me personally.
Sheryl Sandberg speaking with Bloomberg Technology's Emily Chang there yesterday as that news broke. Let's get over to Danny Berger in London for more on this. Really it's an historic move, certainly for women in business, and has to be one of the most well-known companies in the history of the world.
Yeah, absolutely. I mean, there are so many superlatives that we could choose from to kind of say, look, this is a big deal. And, you can see it in yesterday's stock price. You hear it in Sheryl Sandberg talking herself, saying, look, it's been 14 years. She did come in. She did transform this company. She'll be staying on the board. But in terms of why she's leaving, she basically just talked about these philanthropic efforts she wanted to pursue. But two people who worked with Sheryl did tell Bloomberg that some of the baggage at Facebook made it harder to work on some of these issues she cares about, like women empowerment and other things as well. So perhaps that has to do with stepping down. But look, share prices fell yesterday immediately after the announcement. They ended the day about 2.6% lower. So this kind of goes to the key woman risk of Sheryl Sandberg leaving. Recall, she came in after transforming Google into an ad behemoth. She comes into Facebook. She helps do the same thing. And now Facebook is in this transition where they're kind of shifting away from that ad-based revenue model. Of course, that's where the revenue is still coming from. But this focus on metaverse, of course, I've been calling them Facebook. They're now Meta. This focus on that and perhaps shifting to sales there in the metaverse has become the new focus. And perhaps that's gotten a finer point put on it now that Sheryl Sandberg is out, Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. Meta shares rebounding slightly in pre-market trading, up about 0.8% this morning. And as for some other stocks on the move in the pre-market, one big one to the upside is Chewy, of course, the online pet supply retailer. It reported after the bell sales topping estimates. One analyst over at Jefferies saying that this shows the recent sell-off in the stock is overdone. Now we're seeing an outsized move higher in early hours, up about 17%. Apparently, a lot of us, I would include myself in that, still spending a lot of money on their pets for things like dog toys. So many dog toys in my apartment. Another stock that is moving higher is GameStop. It too reported after the bell yesterday. A bit mixed. You had a wider loss than expected, but sales actually topped expectations. We're still awaiting more clarity on just how the NFT marketplace that GameStop is launching is going to work out. But that stock is up about 0.75% before the bell. One moving lower on the back of earnings, though, is Hewlett-Packard Enterprise. It cut its profit outlook for the year, blaming a myriad of factors, including currency headwinds, the war in Ukraine, ongoing supply chain issues, stories that we have heard from many, many companies. But that one is weighing on this stock in particular, down about 6% before the bell, Anna.
Pets and cocktails, two lockdown habits, Kaylee, that look as if they are here to stay. Coming up on this program, it's Diamond versus Kalanovic. JP Morgan's top strategist maintains his optimistic forecast, while his boss warns investors to brace for an economic hurricane. We will take a look at those conflicting views shortly. And on the shake-up at Meta, David Kirkpatrick joins us, Techonomy founder and author of The Facebook Effect. Great to get his perspective on this big change at the top at Meta, plus 70 years on the throne. We'll dive into the economics of the Queen's Jubilee celebrations. This is Bloomberg.
It's a hurricane. Right now it's kind of sunny, things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And you better brace yourself.
JP Morgan CEO Jamie Dimon with a warning yesterday. We saw a different view, though, coming from JP Morgan's chief global market strategist, Marko Kolanovic, who says, quote, there will be no recession given support from U.S. consumers, global post-COVID reopening, and China stimulus and recovery. So what are we to think? Joining us now is Tatiana Dari of Bloomberg Markets Live, fresh in New York, newly arrived. We brought her in out of London. So, obviously, it takes two sides to make a market, and here we have them both inside JP Morgan.
Exactly, and that's quite the contrast from Dimon himself. Just 2 weeks ago, he said the economy is very strong. He said credit has never been so good, and we see here his chief market strategist taking an opposing view and saying that markets will rebound here into year end. But just looking at what other voices on Wall Street are saying, I can tell you that there is a growing consensus on Wall Street taking actually the Dimon view and being more bearish, saying that stocks will probably have to fall. Earnings estimates will probably have to come down, and there's a lot of economic risks out there and also inflation risks.
Well, and of course, there's been economic risks for some time, yet you also had the support of monetary and fiscal stimulus checks in the pockets of retail traders who were always willing to come in and buy the dips in this market. Is that behavior now changing as the macroeconomic picture is changing too?
Well, we've seen retail traders being really active in this latest rally and really being empowered and keeping their participation even while stocks fell here in the early this month. So what's interesting about their participation now is they're using a lot more leverage to do that. So, and then market watchers are saying this could get a little dangerous if we get any more episodes of risk aversion. It could really hurt retail traders. And let's not forget that they're also sitting on big year-to-date losses. I think a basket of Goldman Sachs retail favorite stocks is showing they're still sitting on about like a 25% loss. So they've gained, and they've certainly gotten a win with the latest market rally, but there's still a long ways to go to recovery.
Some worrying signs there, maybe for retail investors. Tatiana, thank you very much. Tatiana Daria from the Bloomberg Markets Live team. And for more market analysis, check out MLIV Go. That is the function to use on your terminal to keep across the thoughts of Tatiana and the rest of the Markets Live team on their blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Banks in China are facing growing pressure to support cash-strapped property developers. Regulators have been pleading for months, but that hasn't boosted lending to the industry. Builders and regulators alike are counting on banks to provide a lifeline as bond funding and home sales dry up. Russia was judged to have breached the terms on a bond after missing a $1.9 million interest payment, and that triggered an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said a failure to pay event occurred on credit default swaps. Still, the failure to pay won't trigger a wider default on Russia's bonds. The U.S. Supreme Court is facing a historic case backlog. The court is due to issue 33 opinions, 53% of its expected total, in the final month of its current term. That's the most in percentage terms in more than 70 years. Among those are rulings that could effectively outlaw abortions in 24 states and put more handguns on the street. And in Virginia, a jury sided with actor Johnny Depp in his libel lawsuit against ex-wife Amber Heard. Jurors awarded him $10 million and vindicated his allegations that Heard lied about Depp abusing her. But the jury also found that Heard was defamed by one of Depp's lawyers and awarded her $2 million. Depp says the jury gave him his life back. Heard says she's heartbroken. And from drama with celebrities, Anna, we turn back to drama in these markets.
Yeah, coming up, Matt Maley joins us, Chief Market Strategist at Miller Tabak. Certainly worth tuning in for after that trial is over. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The price of oil falls after a report that Saudi Arabia is ready to pump more crude as OPEC Plus meets today. Meanwhile, President Biden is likely to visit the kingdom later this month. Soaring gasoline prices are hurting the Democrats' chances in midterm elections. Sheryl Sandberg's complicated legacy. The soon-to-be former COO of Facebook's parent built an advertising giant. But Sandberg also was criticized for the company's failure to rein in large-scale misinformation, hate speech, and privacy breaches. And two very different views of the U.S. economy from J.P. Morgan. Jamie Dimon warns investors to brace for an economic hurricane. He says the only question is whether it's a big or a small one. At the same time, a top J.P. Morgan strategist predicts a recovery for U.S. stocks. I'm Anna Edwards in London with Matt Miller and Kayleigh Lyons in New York. So two different views from within J.P. Morgan really illustrates a lack of direction, perhaps, for these markets at this point, Matt.
Yes, although it looks like Kolonovich is the outlier, right? Dimon is the consensus view. The question, though, as Marco points out, is all of this priced in? And clearly investors, at least today, think some of it is. S&P futures are up about 0.5% right now to 4120. We have investors willing to let go at least a little bit of the perceived safety of U.S. government debt. So the yield rising to 291.13 right now. Nymex Crude coming off, as you said, there was the FT report that OPEC could boost production to make up for lost production if sanctions hurt Russia more. So Nymex Crude back down to 112.75. This is remarkable, because 2 days ago we were pushing 120 for Texas Intermediate. So it's $7 shy of that now. And Bitcoin right now up 1.2% from midnight, although it's down from where we saw it 24 hours ago. It was at 31.6, and right now we're looking at 29.983. Kayleigh, what do you see in terms of pre-market movers?
Well, I'm focused on that oil story, which of course is oil prices moving lower. And as the underlying commodity moves lower, so too does energy stocks in pre-market trading as a whole. You have Occidental Petroleum, Marathon Oil, each down between 1.5% and 2% or so. And really it's the entire energy complex that you see under pressure. But there are some stocks moving higher as well, including Chewy, the online pet store. It reported results that beat estimates. A lot of people still buying things for their pets. All of those pandemic puppies still getting pampered. It's up 16% in early hours. And then, of course, a story we've talked about a lot already this morning, Sheryl Sandberg stepping down as the COO of Meta Platforms. The question really is, how much key woman risk is there for this company? Investors seem to think there was a great deal yesterday because you saw the stock moving lower immediately after that news crossed, but a little bit of a rebound happening in pre-market trading this morning, Anna. That stock up about 0.8% before the bell.
Yeah, a great story, and one we'll return to shortly, Kayleigh, on this programme. Let's check out how European equity markets are doing. We're without London today, of course. London is closed, public holiday today and tomorrow to celebrate 70 years of Queen Elizabeth on the throne. So stocks in Europe depleted in volume, but still there with some positive momentum, up by 0.5% on the Stocks Europe 600. Brent crude echoing what Matt just said about what's going on WTI. Those reports suggesting we might see some change in the Saudi stance when it comes to the amount of oil they're prepared to produce. And Brent crude is down by by 2.5% as a result. Remy Cointreau then, in keeping with those lockdown habits that we've clung on to, Kayleigh was talking about all those puppies that are still being pampered, cocktails still being made in our homes. Apparently, that's the message from the spirits maker out of France, that is Remy Cointreau, and the stock up by just over 4%. And Daimler Truck Holdings, interesting one here. This is the world's largest truck maker, up by 1.7%. They are seeing some more positive signs when it comes to supply chain issues and the shortage of chips, talking more positively about that in an interview, Kayleigh.
All right, Anna, well, let's return to the conversation you and Matt were just having about how Marko Kolanovic of JP Morgan actually is a little bit of an outlier with his rosy outlook. Let's get another take. Matt Maley, Chief Market Strategist at Miller Tabak, is joining us now. So, Matt, clearly Marko is not in consensus here. Consensus says what we're in the middle of right now is just a bear market rally. Is that true, and how much further could it go in that case?
I do think we're in the middle of a bear market rally. Well, the one thing I worry about with that opinion is that so many other people seem to have it. I like to be be one of those outliers that tends to work better. But one thing that is very interesting that I felt that what happened in 2000, people kind of forget we had a deep correction in late 2015, early 2016, and one of the things that really was a catalyst for the bounce back, for the bottom of that, was when Jamie Dimon came out and said he personally bought $26 million of JP Morgan stock. I mean, that literally signaled the bottom of that sell-off. The market turned around and rallied, didn't look back for a couple of years. Now, with the market down 15% again, he's saying kind of the opposite. They're quite a bit different. So, Jamie Dimon, going against Jamie Dimon is not something that people really want to do very often, I think.
Okay, Matt, so that's kind of for the economy and the market at large, but in specific pockets of this market, are there areas in which valuations have come in enough damage has been done, that there is now an entry opportunity?
Well, that's kind of hard for people to argue, in my opinion. I just don't think that the markets. I mean, we've worked off the froth that had been created by the Fed's liquidity. It's even questionable at 17 times earnings if that's really fair value. I think it should be closer to 15 times earnings. And plus, we've seen the economy starting to weaken. And GDP forecasts have been cut in half over the last 6 months, and yet earnings forecasts have stayed the same. They, I believe, will start to come down as we move through the second half of the year. That said, there are some individual stocks. I mean, there's some names, and so you mentioned Facebook or Meta. This stock has gotten much cheaper, and this news will move the stock around a little bit. But I think some of these names like Meta, Facebook, and another one is of course Amazon, that the stocks have been beaten up really badly, are ones that they may still have further to go if the broad market falls. But they're ones that if you buy them every month, a little bit each month, by the end of the year, you're going to have a real nice nest egg there for a nice rally after that.
Cost averaging.
Thanks, Matt, for the translation. Matt Maley, talking about where yields go, and you just referenced it there in connection with tech shares. What is your expectation here? I was reading a piece by John Authers on the Bloomberg terminal just now that was talking about how bond yields, in his view, are too low if we still see mounting inflation pressures. We've got the yield on the US 10-year at 2.91%, but too high if we think that the US economy is going to roll over. Where do you sit on where we maybe end the year?
Yeah, I mean, the whole thing is that this whole thing. What is inflation going to do? And in my view, I mean, I'm old enough to remember the 1970s. I was in school, but I remember it very well. And the inflation, the impact that has, it's like even with the economy weakening, if inflation stays high, interest rates are going to stay high or even move higher. So I'm in that camp that's going to be higher, and that's going to hurt a lot of technology stocks. I just think the ones that I mentioned have come down enough and have become more, their valuations have come down enough that make them a little bit more attractive than many of the others.
Did you ever see Zeppelin live?
I never saw Zeppelin live.
All right. Whenever someone says that was big. School in the 70s, that's what I think of. Listen, Mohamed Al-Arian out with a column that says basically there are two ways this can go, right? In terms of the Fed raising rates and then cutting. We heard James Bullard say that he thinks that's how it should go. The good way is if they do it with the support of a stronger economy. The bad way is if they have to do it to save the economy. And that's kind of the discussion we're having now, right? I mean, Marko is saying that all of this is priced in, and that's easy to believe. The question is, do you think that the economy is going to hold up or not? How important are Fed rate hikes if you have the right view on the economy?
Well, I mean, one of the things, I think some people are missing is that, no matter when the Feds reverse their policy, that massive emergency level stimulus, the market was going to come down, okay? It was because it was very, very overvalued. But also, we know since Ben Bernanke basically changed the way, instead of the stock market, telling us what was going to happen in the future, it was actually causing what is happening in the future. They used it as a tool in the marketplace. Now, so in other words, the stock market coming down is going to have an impact on the economy, and we're just starting to see the beginnings of that now. I think that the economy is certainly going to weaken further. It doesn't matter that inflation's peaked. If it stabilizes at a level that is much higher than we've seen since the 1970s, that's still going to impact people. I mean, who cares if used car prices come down, if energy prices stay high and food prices stay high? That's going to cut into consumer spending. I mean, there's just no question.
And how do you view the consumer right now? Because someone like Jamie Dimon has a really unique view of the consumer. A lot of people are running around this country with J.P. Morgan Chase credit cards, right? Is the consumer starting to get stretched? Do they still have those stimmies? Have they spent them, and are they borrowing now? What do you think?
Yeah, definitely. I mean, we're starting to see, these credit card balances are starting to move up, and it shows that consumers are needing to borrow to try to maintain their lifestyle. And at some point, I mean, over 60% of Americans live paycheck to paycheck, and when you have to put much more into food and into heating your home or driving your car, that gives you less to spend in other areas. It's not all that difficult, and but it's a lot different than when we've seen in the past. And at some point, yeah, it's great when people start to borrow on their credit card, but at some point soon, in my opinion, people are going to say, something, we've got to pull in our horns a little bit. We had a lot of pent-up demand from another winter of COVID. That's kind of washed out, and I think as we move through the summer, that pent-up demand fades, people are going to be spending less.
Matt, thanks very much. Matt Maley of Miller Tabak, thank you for your time. Coming up on this program, we will talk about Meta. David Kirkpatrick, Techonomy founder and author of The Facebook Effect. What does he make of the news of the departing COO, Sheryl Sandberg? We'll get to that conversation next. This is Bloomberg.
David.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Goldman Sachs Global Head of Commodities Research, Jeff Curry. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
I made a final decision this weekend and let Mark know. I think, the rules are such that once I've made a decision, we do not have a lot of time to announce. So that's why the timing between decision and announcement is so tight.
That was Meta COO Sheryl Sandberg speaking to Bloomberg Technology's Emily Chang exclusively yesterday following Sandberg's announcement that she will be stepping down from that role after 14 years. For more on this historic moment and what's next for this historic company, we're joined by David Kirkpatrick, founder of Techonomy and the author of the definitive book on Facebook. It's called The Facebook Effect. David, thanks so much for coming in early. Really appreciate.
Thanks for having me, Matt.
Your take on this. I mean, when I first read this story, I thought this is a huge moment because not only is she one of the most powerful female executives in world history, right? Facebook is a company that touches more lives than almost any company ever has. So this is just could be a huge turning point, right?
Well, for much of her career, she's pretty much been the most famous business leader who wasn't a CEO, really. I mean, she is an astonishingly important figure in modern business. So it is a historic moment because in in large part, Mark Zuckerberg invented Facebook, but Sheryl Sandberg invented the business. And that's a big deal because it was the most profitable business anybody ever invented for much of its history on a profit per dollar of revenue basis. I mean, Facebook has been an incredible, historic, unprecedented profit machine, and Sheryl created that ad business. It barely existed when she arrived. So that is a massively important thing. There are, unfortunately, a lot of really painful and even sad parts of her regime that we have to also touch on, I think.
Well, and that's something one of our Bloomberg opinion columnists here, Parmi Olson, touched on in a column out on the Bloomberg. I'll read a bit from it. Sandberg's skill in growing the business came at a price for Facebook's users, for healthy discourse, arguably for democracy itself. For Facebook's critics, the company was causing damage to society because of a growth at all costs mindset driven by Sandberg and Zuckerberg. So I guess my question is, to what extent does that live on even after she's gone?
Oh, it lives on completely. I mean, I think it's very hard to know the exact machinations that happened over the last decade between Mark and Sheryl. My guess is that even though Sheryl has done way too little to acknowledge and remediate the harms that Facebook has caused in the world, Mark is more reluctant and resistant to the reforms that most rational people would like to have seen than Sheryl would have been. But she didn't really have the power. Let's remember, Facebook is an autocracy with one person having all power, unlike any other giant public company that I can think of. So I suspect that Sheryl would have done things differently if she had been the CEO, and it doesn't seem out of the question that even now, one reason she may be leaving is that she finally just got tired of not being able to really get her decisions accepted within the hierarchy of the company. That is a real possibility.
Okay, so what's the worst case scenario of what Meta looks like without her?
Well, it'd be hard for it to be much worse than it's been in recent years. That's the scary part. I mean, I have a lot of faith in the intelligence and the technical acumen of the people surrounding Mark and of Mark. I mean, Javier Olivan is an incredible business person and technologist and leader who's taking over the COO role. But look, democracy is in the decline globally, and autocracy is on the rise, and Facebook is the world's #1 media platform. Those things go together. Because Facebook really hasn't successfully governed itself for a time. It really didn't. Mark never anticipated the power that his service would have in public discourse and discord. That was an interesting slip of the tongue. But discord has really flown from the discourse. So I think there is a strong impulse inside Facebook to try to do the right thing, but they don't really know what it is. They have 30 or 40,000 people who try to read the posts, and they don't do it in all the languages. That's one of the big, serious, ongoing problems. They've never even tried to do it in many, even most of the languages. So, they can't really solve it.
And so, David, just adding on to what you're saying there about the difficulties they face. I mean, when do we need the democratic process to sort of step in and take on Facebook and take on other big tech companies? When do we see that actual showdown? Because we've seen it threatened many times.
We're seeing that now in Europe with the Digital Services Act and the Digital Markets Act, and with a bill that's being shepherded through Congress right now that's a bipartisan effort to target Facebook, but also the other tech giants, the internet giants. The government is finally waking up to the harms that Facebook in particular has caused. They also focus on YouTube and a few other tools that are out there. But Facebook, because of its scale and because it really has become the media platform for the planet, is the most important and, unfortunately, in addition to its many positives, the most harmful. But government is waking up, there's no question.
Does it tell us anything about the future of Meta? This is a business recently reinvented as Meta, and it's clearly Mark Zuckerberg's. It's Mark Zuckerberg's. Well, you wrote the book on them, so you're allowed. But it's Mark Zuckerberg's reinvention, isn't it? Does it tell us anything about maybe other views at the top about where the company should go next?
Well, it sure does. That the leadership of the company is aligned behind this supposed vision of the metaverse, which I find highly suspect and unlikely to succeed in any near term.
I love it.
Well, you would love it. It goes with a good Zeppelin concert online, in the metaverse.
You can attend in the metaverse.
But look, I'm not saying it might not happen down the road, but I'm telling you, for a service that serves 3 billion people, There is no near-term prospect that even 1 billion people want to spend most of their online time in the metaverse. That is not even a possibility. In 2030,
don't we already do that with Instagram and Facebook?
But not with
I've never
legs, not with no legs and weird cartoony avatars that look like they came out of a manga game. No, I don't think the world is ready for that. I think it is a vision that has a lot of power within the company, and there's a lot of people in tech that are big lined up behind it. But I don't think it is a near-term vision that's going to affect Facebook's business. The business continues to be the business it has been for the last decade. And Sheryl ran that very, very well, except for the governance part. You always have to qualify. You can't really say anything overwhelmingly positive or overwhelmingly negative about Sheryl Sandberg. She was an astonishingly effective leader who had a major blind spot.
And then there was Lean In. No time to talk about that, David, but we know that she's going on to do other things that connect in with that and the book she wrote on women in business. David Kirkpatrick, thank you very much for joining us. Economy founder and author of The Facebook Effect. Coming up on this programme, 70 years on the throne, we'll dive into the economics of the Queen's Platinum Jubilee celebrations this weekend. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kayleigh Lyons in New York. Now it is the Queen's Platinum Jubilee bank holiday in the UK today and tomorrow. And many people who don't work in television will be looking forward to a few days relaxing at home. But what effects might we see on the country's economy? Laura Wright has been investigating. She joins me here on set in London. Economists expecting a short-term economic bounce then, Laura. The pubs are open late, I understand. So a chance to forget about the cost of living crisis and go out and celebrate.
Exactly. Well, forward-looking data tells us that revenge spending is likely to take place across retail, hospitality and the travel sector as we indulge in Victoria's sponge cakes, street parties, visiting friends and family. Data from Springboard tells us that retail footfall is expected to be up 8% this week compared to last week. The hospitality sector is projected to bring in £2 billion over the extended holiday. To put that in context, it's almost £400 million higher than a typical Thursday to Sunday trading period at this time of year. And Anna, what's really interesting is the travel sector. Syrian flight data shows us that UK flight departures up over 200% year over year. Passengers excited to travel.
I mean, okay, so this is what's happening the next couple of days, but I want to step back and take the 35,000-foot view, We're talking about a 70-year jubilee. What has changed?
Well, Matt Miller, 70 years, it's probably closer to your early memories than it is for mine, Anna's or Kayleigh's. But back in 1952, the population of the UK, 51 million. Today, it stands at 67 million. The average house price, £1,800. In today's money, that stands at around 56,000. But I've had a look at historical bank holidays when it's been a Jubilee celebration, such as in 2002 and 2012. And for the month when that extended holiday takes place, GDP typically falls by around 2%. Using that analysis for the quarter, it's a knock of 0.5% of GDP, which means that for the second quarter of 2022, GDP will be in contraction territory.
You see, you tried to knock her off there, Matt, but Laura Wright, she's ever professional. She brought it back to the
it's
economics.
All about the bank holiday,
Laura,
right?
thank you very much. Laura Wright's here in London with the data on the bank holiday. That is it for the early edition. Surveillance is ahead with Tom, John and Lisa. This is Bloomberg.